The CRA doesn't want you to know this. 3 legal ways to pay less taxes in Canada, 2025. Welcome back to Canada Chronicles. Have you ever wondered why, no matter how hard you work, it feels like the Canada Revenue Agency always finds a way to take a bigger slice of your income? You're not alone. The good news is there are completely legal ways to stop overpaying and start keeping more of what you earn. In today's video, we're breaking down 3 powerful strategies that can help you pay less tax in 2025. These are the same methods financially savvy Canadians and business owners use, all fully compliant with the Canada Revenue Agency's rules. And make sure to stay until the end, because we'll reveal a secret that the wealthy have mastered for decades. The holding company strategy, how the rich defer taxes legally. It's a smart, perfectly legal way to control when and how you pay taxes, and it could completely transform the way you handle your income. So if you're ready to understand the system and use it to your advantage, hit subscribe, turn on notifications, and stay tuned. Let's get started. Why 2025 matters more than ever. This year isn't business as usual for taxpayers. Several new changes came into effect that could directly impact your bottom line. Middle-class tax cut. The lowest federal rate dropped from 15% to 14% as of July 1st, 2025. Since it applies for only half the year, the blended rate is about 14.5%, saving the average family around $650. Alternative minimum tax. Updated rules now impose a 20.5% minimum rate while restricting certain deductions for high-income earners. Corporate tax updates. Nova Scotia increased its small business limit to $700,000 and cut its lower rate to 1.5%. Prince Edward Island lowered its general corporate rate to 15% and raised its small business limit to $600,000. Capital gains inclusion. The federal government canceled the planned increase, keeping the inclusion rate at 50%. These updates make 2025 a key opportunity to reorganize your finances before more changes roll out. Strategy 1. Maximize your registered accounts, RRSP, TFSA, FHSA. Registered accounts are the simplest and most effective way to save on taxes, yet more than 40% of eligible Canadians still leave them unused. Registered Retirement Savings Plan, RRSP. Contributions reduce your taxable income today, and withdrawals are taxed later, ideally when you're in a lower bracket. For 2025, the limit is 18% of your 2024 earned income, up to $32,490. Example, if you earned $100,000 in 2024 and contributed $18,000, you could save roughly $4,700 in taxes this year, savings you can reinvest to grow faster. Tax-free savings account, TFSA. Any income, dividends, or withdrawals are completely tax-free. The 2025 limit is $7,000, bringing the lifetime total to $102,000 if you've been eligible since 2009. Investing $7,000 per year at a 7% return could grow to about $138,000 in a decade, all tax-free, compared to losing thousands to taxes in a regular investment account. First Home Savings Account, FHSA. Deduct up to $8,000 per year to a lifetime cap of $40,000 and withdraw tax-free for your first home. It combines the RRSP's deduction power with the TFSA's growth advantage, ideal for renters saving for their first property. Bottom line, these are government-approved tax shelters that help you grow wealth faster. Use them to their full potential before looking at riskier tax strategies. Strategy 2. Incorporate and use business income wisely. Employees pay tax on every dollar before they even see it. Business owners, however, can deduct expenses first, pay tax on the remaining profit, and decide when to take money out. Canadian-controlled private corporations, CCPCs, allow entrepreneurs, contractors, and self-employed professionals to take advantage of this flexibility. Here's why incorporation makes sense. 1. Lower tax rates. Pay a combined rate of about 11 to 12% on the first $500,000 of business income. 2. Expense deductions. Write off home office costs, vehicles, software, travel, insurance, and other legitimate business expenses. 3. Income control. Mix salary and dividends to stay in lower personal tax brackets. 4. Deferral. Keep profits inside the company to reinvest. Personal tax applies only when you withdraw. Example, a consultant earning $300,000 pays around $120,000 in personal taxes if employed. Through a corporation in Ontario, the same income is taxed at roughly $36,000, saving $84,000 that can be reinvested or used for growth. Stay compliant. Keep records of receipts, mileage logs, and corporate documents. The Canada Revenue Agency audits small businesses more often, but with proper organization, you'll stay protected. For freelancers, professionals, and tradespeople, incorporation remains one of the most powerful long-term tax shields available in Canada. Strategy 3. Use real estate and capital gains to your advantage. Principal residence exemption. When you sell your primary home, any profit is completely tax-free if it was your main residence the entire time. Buying at $500,000 and selling at $900,000 means a $400,000 gain. All yours untaxed. Rental income and deductions. If you own rental property, the Canada Revenue Agency allows deductions for expenses like mortgage interest, repairs, utilities, property taxes, management fees, and insurance. You can also use capital cost allowance to defer part of your tax burden, though it reduces your property's cost base when selling. The capital gains reality in 2025. The federal government confirmed the capital gains inclusion rate remains at 50% for individuals, corporations, and trusts. The $1.25 million lifetime capital gains exemption continues for qualifying small business shares, farming, and fishing property. Timing is everything. Selling assets in a high-income year could push you into a higher bracket, while spreading sales or using capital losses can dramatically lower your tax bill. Example, selling an investment property for a $400,000 gain means $200,000 is taxable. At a 33% rate, you owe about $66,000, but careful timing could save you tens of thousands. Real estate isn't just about appreciation. It's about using timing, planning, and good records to your advantage. The problem and the solution. Most Canadians lose money because they rely solely on employment income, the least tax-efficient form of earnings. The solution is simple. Combine these legal strategies. Maximize your registered accounts, use business structures for flexibility, and plan your real estate moves strategically. But there's still one more tool that separates the wealthy from the rest, a structure that allows you to defer taxes, protect profits, and build wealth over time. Thanks for staying with us this far. We appreciate your time and hope you're finding this information valuable. The holding company strategy, how the rich defer taxes legally. Imagine running a business that earns hundreds of thousands each year and having the power to choose when to pay yourself and when to pay taxes. That's what a holding company structure makes possible, and it's fully compliant with Canada Revenue Agency rules. How it works: create a separate company, known as a holding company, to own your main operating business. The operating company pays tax-free intercorporate dividends to the holding company. The holding company then invests that money in assets like real estate, stocks, or bonds, and no personal tax is paid until you withdraw it. Why it matters. The new alternative minimum tax rules make deferral more valuable than ever. It shields profits from lawsuits or business risks since funds stay inside the holding company. You control when to declare dividends, letting you plan for lower tax years. Example, a business earns $400,000 after expenses. Instead of withdrawing it all and paying top rates, $250,000 is transferred tax-free to the holding company. Invested at 7% annually, it nearly doubles in 10 years, and you decide when to take it out and pay tax. Rules to follow: keep proper documentation for dividends and shareholder loans, repay loans within a year, avoid the tax on split income by meeting active shareholder tests, and maintain an accurate capital dividend account to track non-taxable distributions. If the holding company earns over $50,000 in passive income, the small business deduction of the operating company begins to phase out. So balance your investments wisely. This strategy isn't about avoiding taxes. It's about controlling them, making your money work smarter, and letting profits compound on your terms. Putting it all together. 1. Maximize registered accounts to reduce taxable income. 2. Use a business structure to claim deductions and control timing. 3. Leverage real estate and capital gains to grow wealth strategically. 4. Build long-term stability and control through a holding company. The Canada Revenue Agency plays by a complex rulebook, but now you know how to use those same rules in your favor. Stay informed, stay strategic, and keep more of what you earn. And that wraps up today's video. As you've seen, the system may seem built against you, but when you understand it, you can make it work for you. By using the right combination of registered accounts, smart business planning, and tax-efficient investments, you can achieve true financial freedom. And if you want to go even further, remember the holding company strategy, the same method used by the wealthy to defer taxes and protect profits for years to come. If you found this helpful, don't forget to like, share, and subscribe to Canada Chronicles, and turn on notifications so you never miss our next update on money, immigration, and life in Canada. Thanks for watching, and see you in the next video.